Today's number is 7,000. Why? Well, it's where Tom Lee believes the S&P 500 could be at the end of the year. But could that actually happen when we've lost so many of the top 10 stocks in terms of momentum? Palantir's lost heaps over the last couple of sessions and seen one of its biggest sell-offs ever. The Qs have now started to move down to a key support level. And, of course, we've seen crypto starting to crash across the board. So is there more to come? Well, in today's video, we take a look at some of the dark macro side economics that seems to be causing some of this concern. And we look at delinquencies and bankruptcies to see whether they could be something on the horizon. Also, are there other opportunities? Well, the answer is always generally yes. Let's take a look at stocks, commodities, and cryptos and break down what we should be looking at right now together. See you soon, guys. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we'll cover the latest macro, the key market flows, and of course, what is happening with some of the biggest Wall Street players right now. Let's start things though with Fundstrat, because of course, Tom Lee's fund macro research report, the latest one, says that the S&P 500 may reach 7,000 by year end. I'd be interested to know your thoughts, so put them in the comments down below. Do you think we can get 7K on the S&P considering the current headwinds in front of the market? Now, the main two reasons for this were the possibilities of a dovish Fed and the recovery in the ISM manufacturing index. So those will both be wanting to be watched. Specifically, we've got Jackson Hole as well coming up in less than 24 hours. So we'll find out specifically on Friday whether Jerome Powell might be starting to say, well, I still don't want to do a rate cut because of those PPI data information, and we're still concerned about inflation. Obviously, that could put some problems underneath this call on the markets. Now, on top of that, we've also entered into Q3, which is that notorious August, September, October period. Tends to be incredibly volatile, and we'll show you very soon what we generally expect to happen at this point in time based on the data. Let's also kick things off with some of the bad macro signs. Now, these do not instantly add into the economy, nor do you instantly see sell-offs when you get these types of events, but they're important to note and to have on hand so that you're aware of all of the information. And of course, on the channel, we like to cover these for you guys. First up is US shipments. They're falling off a cliff, and that could be, of course, a stark reminder that demand may actually be slipping here in the US economy. Now, this is probably tariff related, and it is starting to show up in some of these shipment numbers. Remember, what happens in the freight market generally ends up boiling over to everything else. We also saw home prices falling in 39 major US metros in July. Now, I think this is the highest since 2012, which isn't actually on this chart, but that's a pretty worrying sign. And what it tells us again is that the debt markets, or at least people taking on debt, there are kind of concerns here, and some people are being squeezed by these higher for longer interest rates. Now, of course, this is 39 out of 50, and it's a pretty big deal. So I would certainly be paying attention to house prices, especially over the next 6 to 12 months, as what happens there can often lead into bigger problems. What about the percentage of balance of delinquencies? Well, of course, there's one shocking one that you've probably already seen by now, which is the student loans. Of course, we know why. But at the same point, that has spiked up. Main thing here is probably credit cards, which is starting to get back up there. And the funny thing is we've got delinquencies this high, yet we're not actually currently in a recession. Now, remember, the last time we saw delinquencies like this was actually after the recession in the US, where people were living off credit cards because they didn't have jobs. It's a very unique circumstance from that. We're also seeing a little bit of a tick up here in certain things as well, and particularly auto loans are starting to get a little concerning in the US. I've heard some people that literally are putting something like 70% of their wages into car loans, which is stupid. So if you're doing that, please do not do that, guys. I know no one in this community does that, but if you do know someone that has those types of epic numbers, put it down in the comments down below. I wouldn't mind highlighting a couple of those. That is some wild stuff. At the same time, registrations of businesses obviously did tick over to peaks a few years ago. We have basically seen, especially in the US, 22 to 23 was a massive time for new businesses to start up. But guess what's happening now? Lots and lots of bankruptcies. This is in the EU. So, of course, we're starting to see, not too many new businesses, but heaps and heaps new highs in terms of actual bankruptcies and declarations coming through. So people are struggling out there. Another couple of things here is that AI bubble, of course, is rolling on. You can see here Todd Sohn, some good stuff here from him from Strategas. And overall, I've got to say, this is a amazing rally in terms of AI-focused ETF flows over the last 65 days. Look at this. Wow. Everyone's been jumping into the AI bubble. And while that's fine, of course, we do know that it's driven up most of the market. Remember, 10 stocks have allocated 80% of the gains, which is something we've been looking at. It does remind you, though, that if we lose that momentum, which it looks like we may have, then that, of course, is going to stagnate the index and create what we call a pit or a pullback in time, which looks something like this. Now, we'll just quickly mention that about this time, probably in the video yesterday, we had the devil voice appear, guys, and that was Wall Street trying to tell us not to talk about rotation. But many of you in the comments section had a good laugh. It was a bit scary. I got to say, I listened to it back and I was like, what is going on? That was definitely an audio mixer issue. So if it ever happens, that's what it is. It isn't the devil taking control of me. Let's have a look here at EM corporate credit spreads. Yeah, they've dropped. And of course, this shows us that across the board, emerging markets, US markets, doesn't really matter. Nobody seems concerned about the current debt levels, and bonds continue to rise, specifically high yield bonds. So no one really seems to think there's any concern out there in markets right now. What this does lead into, though, is a potential broadening of the current rally. Once you see 30-40% of stocks rally everything, then of course you might be starting to see rotation. And we mentioned this about 5 days ago that maybe healthcare and other sectors were starting to see a little bit of a pickup. Value as well seems to be doing very well. Equal weight markets doing very well. And you can see here that healthcare has now become the best 5-day performer. And over the last 24 hours, it was also up there. So markets are clearly showing a bit of rotation underneath the hood. And the reason could be this. Retail has gone pretty much all in. So retail's massively in the markets. And of course, some of the big funds are behind what they should be doing. There's a big discrepancy between them. And what do they like doing? Sometimes they like to make a little bit of a pit or a pullback so that they can get better price. This comes off the back of one of the largest transactions we've ever seen in the triple Qs, which is, of course, the most popular NASDAQ ETF. And that was the second largest happening near the tops. And of course, since then, we've seen 2 reddish days. So is everything concerning? The answer is simply no at this stage when we're looking at least the data. And although the macro shows some big problems, of course, if you're looking at the data, Wayne Whaley's data here, very good. It shows you that this is what's expected around this period of time. If you have a look here from September 19th to October 12th, that's often a little bit nasty. But then if we do get pullbacks, yeah, they've got pretty good track returns, as you can see here. And you may say this time's different, but it is following a very similar pattern to post-election years when we look through the data all the way back, and year 3s of bull cycles, which tend to be choppy into the end of the year. And you can actually see here, they tend to chop down and then they rally back up. So at least that's what we have to expect in terms of structure until we're proven differently. This also brings into crypto because, of course, crypto is notorious for its 20%, 30% drop-offs. We saw, of course, MSTR Michael Saylor come out and he said, volatility is a gift. The market started dropping almost instantly. He's got a bit of a tweet knack, it seems like, on that one. But really, to take jokes aside, this is something that generally does happen. We often see a bear trap in something called the halving cycle, and then we often get one last blow off. Now, we don't know it's going to happen. Nobody does, but we are tracking very similarly to last ones. Here were the dumps during those previous periods. Here were the rallies that came afterwards. So, of course, we are here at this stage. What if we saw something like this? It's plausible. We don't know because we haven't lost 112 on Bitcoin yet. But if we do, that may pull us down. The other thing to note is that if we do see a larger sell-off from here in August, it's unlikely, not impossible, to be a major top because only one other time since the 1980s have you seen a major top at these levels. But to keep it in mind, we are in, at least in my opinion, some form of bubble because valuations are insane. Not that that matters at this stage, but you can see here, if you take everything considered, yeah, we're up there with some nasty territory. We've been here once before. It was 2021. We then saw a correction in markets. So we've got to keep our eyes open. And that means, of course, subscribing to this channel if you haven't already, because then you'll be updated with heaps of macro, heaps of data, and the information that hopefully you need to make better decisions yourself with. Now let's have a look here at the S&P. It was dump, then rally. Funnily enough, or maybe not so funnily enough, it closed right on that 6,400 level, which we looked at in the options side. So no surprises there. When we go over to options high-low levels, here they are. And I don't think there was too much to note really from the S&P. We fell down to 63.75. We managed to close above that, which I think is a key for the bulls. We hit the daily 20, so they may try to rally it through. But I think probably when we look at the NASDAQ later, we might get a little bit of an information. And of course, then there's the options, which we'll do right now. All right, well, let's take a look at the net expirations for the S&P. And the big one here is, of course, continuation of the old 6,400. This remains a major, major level. And it looks like we've got huge amounts of puts stacking for the 22nd as well, in terms of what we're getting here. So heaps and heaps of puts all the way through from 64 down to 63. So I think we've got kind of the key levels. It's going to be each 100 points here on the downside. And I do still see a huge amount of stacks coming through for major expirations into September. And they're all happening at around 6K. So remember, if we lose 6,200, which is a major level on the S&P, then it's likely that the next flow could be down to 6K. For now, 6,400 remains this kind of key level. And we just closed underneath it, but we did see a big recovery in terms of wick. So as we look at the NASDAQ later on today's video, it'll become a little bit more clear, but this certainly is something that you need to pay attention to. Negative gamma will be fully underway underneath 6,400 with a proper close. Let's have a look at Tesla. It's something similar, 325 on the put level and 350 remains the call wall. And Nvidia is the same thing with the 170 now becoming the put wall. And of course, it couldn't get through 185, at least on this run, which we've been talking about for ages. Now let's go through to the culprit, because it was Palantir really that's dropped from the top to the bottom now 25%. Now you might think, well, that's too much. It has to buy up. This is where really the traps begin though. Remember, a quality run is filled with lower volatility and of course a series of higher highs and higher lows. Now when you get higher volatility, e.g. here, that can mark the end of runs. So of course, we've seen this before. We know that there were rallies in it. It can go into what we call a pit. And at least in my opinion, there's going to be a lot of fast trading action on Palantir. Now, did Palantir top off? Maybe for now in terms of euphoria. But you can see here that it was bought up pretty strongly after falling quite a lot during the session. And I don't think it was that easy to pick that level. It was a bit difficult when you're looking at it because, of course, there's a bit more guesswork. There'd probably be some anchored VWAP behind there or something. But in general, yes, that is the first kind of little sign of at least a bid. A lot of the times bids will kind of stall before they get near the highs. So just be careful with the buy the dip if you're on this one. I expect Palantir to continue to be quite volatile. On the other side is the market actually weakening? Well, RSP, which is the equal weight, is not really weakening. So you can see here, it's almost at an all-time high. And that again goes into that line of rotation is the current discussion point. It's not like the market's freaking out on debt delinquencies and bankruptcies just yet. It's doing it because of rotation. And you'll really see this when you look at semiconductors versus SPY, which came off our blue line and nailed it and started to recover again. So this is still intact for now. Semis are still technically in an upward trend in terms of they're actually still holding against the SPY as a ratio. But now we've got some lines in the sand. 0.44, we close underneath that. It's probably going to create further correction territory. The bonds market didn't seem to care, which seems to be the thing, but we'll get updated data on that and share it. And of course, the US dollar is just slowly climbing up as a bit of risk off does appear. Luckily, gold didn't suffer, even though the dollar went up a little bit. So gold came up a little bit, still stuck within that really tight pennant range. So eventually we'll get a breakout. We don't know which way it is yet. I'm, of course, going to go with the bull side because I'm macro bullish on this and have been for a very long time, multiple years. And 34.50 is a level I'm looking at, and I'm still looking at 33.75 closure above. Silver did well as well, recovering off the daily 50, which it's now done twice. So I'd like to see a new high on silver. And Nvidia went underneath, of course, the daily 20, sold off, then recovered off its old demand block over here. So look, is this enough of a pullback? Probably not, considering what we're seeing. But the problem with what we know data suggests is it gets really weird and up and down and all around. So it may be looked for the rotation rather than look for just the tech stocks at this stage. But hey, you've got to also have different styles for different markets. So it looks like we could be in this kind of chop market for a little while. Tesla, yes, it dropped down, then it recovered a little bit, similar to the others. And again, we've seen the options on that. And China was less volatile. You can see here KWeb basically rallying to a positive close by the end of the session. And that makes sense when you look at it, the HSI as well. It's been a series of higher highs and higher lows. Remember, China's market is different to the US. It's based mostly on massive liquidity from their central bank. The US 2K held okay, considering, again, showing rotation holds. And the NASDAQ came down to probably one of the worst looking trend lines I've seen, but it did come down to it. Dumped underneath, rallied back up. And I think we've got a line in the sand around here. So really the market remains bullish still until something like this happens. And you got to remember, even if this does happen, the weekly and monthly is still going to be up for quite some time. So it's likely that if we drop these levels, at least the next level of equilibrium is back here in the 21.7 area. And that could be exciting for some of you guys getting a bit of a dip. But for now, it's just that kind of very small 4% dip. A bigger one would be about 9 to 10 on the NAS and about 7 to 8 on the S&P. So some key levels there. Ethereum did bounce up. I don't know if that's enough for me, the daily 20, but anyway, it did bounce up. And the big thing here was probably that large transaction that came through. So if you did buy that one with that big trade that came through that we reported the last 24 hours, congrats to you. I guess it was a pretty good session. But the big one, Bitcoin, didn't really do the same thing. It just held on to 112, and this remains where alerts need to be set, because we drop 112, probably in here in this previous kind of equilibrium level of about 105 could be open, or even 98. So I would almost prefer it does this, because if it does that, then of course it marks more territory to previous halving cycles, and then maybe we do get that alt season coming off the rally if that actually does occur. Things to watch, guys. Jackson Hole Symposium. Obviously, we get this all kicking off very soon. You can see day 1, day 2, Fed Chair Powell speaks, and the question will be, is he going to give us any insight into what's happening next with interest rates? Remember, Tom Lee's call kind of requires many interest rate cuts at this stage. If they hold them and don't cut them, the market may not like it. So in summary, there's always another opportunity, guys. There are plenty of opportunities in these markets moving forward. And obviously the most concentrated markets are now in a little bit of decline. And that's because they went high volatility. So there's some lessons to be learned here. If you enjoyed today's video, please remember to subscribe, and we'll see you in the next one. Bye for now.